Chapter 13, Money and the Banking System. What is money? Money is whatever is generally accepted in exchange for goods and services, accepted not as an object to be consumed, but as an object that represents a temporary abode of purchasing power to be used for buying still other goods and services. This is from Milton Friedman, 1992, and other prominent economists. What is money? It's a medium of exchange. Money is an asset used to buy and sell goods and services. It's a store of value. Money is an asset that allows people to transfer purchasing power from one period to another. It's a unit of account. Money is a unit of measurement used by people to post prices and keep track of revenues and costs. How the supply of money affects its value. Why is money valuable? The main thing that makes money valuable is the same thing that generates value for other commodities, the demand for money relative to its supply. People demand money because it reduces the transaction cost of exchange. If the purchasing power of money is to remain stable over time, its supply must be limited. When the supply of money grows rapidly relative to goods and services, its purchasing power will fall. How is the money supply measured? Two basic measurements of the money supply are M1 and M2. The components of M1 are currency, checkable deposits, including demand deposits and interest-earning checkable deposits. M2 is a broader measure of money. It includes M1, savings deposits, time deposits of less than $100,000, and money market mutual funds. The composition of money supply in the United States is comprised of the following. M1 and M2 money supply in the United States as of February 2020. We can take a look at each one. Money is an asset. The use of a credit card is merely a convenient way to arrange for a loan. Credit card balances are a liability. Thus, credit card purchases are not money. Questions for thought. What is money? What are the three major functions of money? What are the major services provided by money? Would money provide its users with more service if there was twice as much of it? Is money an asset or a liability? Are outstanding credit card balances counted as part of the money supply? Why or why not? The business of banking. The banking industry includes commercial banks, savings and loans, and credit unions. Banks are profit-seeking institutions. Banks accept deposits and use part of them to extend loans and make investments. Income from these activities is the primary revenue source. Banks play a central role in the capital market, the loanable funds market. They help bring together people who want to save for the future with those who want to borrow for current investment. The functions of commercial banking institutions. Banks provide services and pay interest to attract checkable savings and time deposits. Some of these deposits are invested and loaned out, providing income for the bank. Banks hold a portion of their assets as reserves, either as cash or deposits with the Fed to meet their daily obligation toward their depositors. Fractional reserve banking. The U.S. banking system is a fractional reserve system. Banks maintain a fraction of their assets as reserves against their customers' deposits. Vault cash and deposits held with the Federal Reserve count as reserves. Since '08, the Fed pays banks interest on reserve deposits held with the Fed. Reserves can be used to extend loans and make investments. Under a fractional reserve system, when a bank uses its reserves to extend new loans and undertake investments, it expands the money supply. How banks create money by extending loans. Consider a banking system where only cash held by the bank counts as reserves and that banks are required by law to maintain 20% against checkable deposits. The creation of $1,000 in new reserves will potentially increase the money supply by $5,000. How banks create money by extending loans. The fractional reserve requirement places a ceiling on potential money creation from new reserves. The lower the percentage of the reserve required, the greater the potential expansion in the money supply resulting from the creation of new reserves. For example, if banks hold 20% in reserves, the extension of new loans could result in a potential expansion of the money supply by a factor of 5. See the table on the previous slide. If banks hold only 10% in reserves, the extension of new loans could result in a potential expansion of the money supply by a factor of 10. Actual and potential deposit expansion multiplier. The actual deposit expansion multiplier will be less than the potential because some people will hold currency rather than checkable deposits, and some banks will not use all their additional reserves to extend loans. Beginning in October of '08, the Fed began paying banks interest on their reserves. This interest rate can be used to affect the reserves held by banks and the size of the actual deposit expansion multiplier. Questions for thought. What is the primary source of earnings of commercial banks? Number 2, what is fractional reserve banking system? Under a fractional reserve system, if banks extend additional loans, what will happen to the money supply? What factors will affect the incentive of banks to extend loans rather than hold reserves? Suppose you withdraw $1,000 from your checking account. How does this affect A, the money supply, B, the reserves of your bank, and C, the quantity of additional loans your bank can extend? The Federal Reserve System. The Federal Reserve, or the Fed, created in 1913, is the central bank for the United States. The Federal Reserve is supposed to provide a stable monetary climate for the operation of the entire U.S. economy. It controls the supply of U.S. dollars, serves as a banker's bank or bank of last resort for U.S. banks, and regulates the banking sector. In short, the Federal Reserve is responsible for the conduct of U.S. monetary policy. The Board of Governors is at the center of Federal Reserve operations. The board sets all rates and regulations for the depository institutions. The 7 members of the Board of Governors also serve on the Federal Open Market Committee, or FOMC. The FOMC is a 19-member, 12-voting board that establishes Fed policy regarding the buying and selling of government securities. So, if we take a look at the chart over here, we have the Federal Reserve Board of Governors, 7 members appointed by the President with the consent of the Senate. You have the Open Market Committee, Federal Board of Governors, plus 5 Reserve Bank presidents, alternating terms. New York is always represented. Then you have 12 Federal Reserve District banks with 25 branches. Commercial banks, savings and loan associations, credit unions, mutual savings, and then the public household and business. The Federal Reserve Districts. This map indicates the 12 Federal Reserve Districts and the cities in which the district banks are located. Each of the district banks monitor the commercial banks in their region and assist them with the clearing of checks. The Board of Governors of the Federal Reserve System is located in Washington, D.C. The independence of the Fed. The independence of the Federal Reserve System is designed to strengthen the ability of the Fed to pursue monetary policy in a stabilizing manner. Fed independence stems from A, lengthy terms for the individual members of the Board of Governors, 14 years. However, the impact of the lengthy terms may be more apparent than real. Because of attractive private sector alternatives, the average tenure of federal governors appointed since 1980 has declined to less than 5 years. The Fed derives its revenue from interest on the bonds that it holds rather than allocations from Congress. Questions for thought. Are the following statements true or false? Interest earned on its bond holdings provides the Fed with income that is substantially greater than the cost of its operation. B. Congressional appropriations provide the Fed with the funds to cover the cost of its operations. And C. After deducting its expenses, the net earnings of the Federal Reserve System are turned over to the U.S. Treasury. How the Fed controls the money supply. 4 tools the Fed uses to control the money supply. The Fed has 4 major tools they can use to control the money supply: reserve requirements, open market operations, extension of loans, and interest paid on bank reserves. Controlling the money supply, reserve requirements. Prior to March 2020, the Fed required banks to maintain reserves. vault cash and deposits with the Fed, equal to approximately 10% of their checkable deposits. If the Fed wanted to increase the money supply, it could lower the reserve requirement, increasing the funds available to banks for the extension of loans. Raising the interest requirement had the opposite effect. In recent decades, reserve requirements were seldom changed by the Fed. Since '08, interest payments on bank deposits with the Fed have been used to control the level of reserves. In 2020, required reserves were eliminated. Open market operations, the buying and selling of U.S. Treasury bonds and other financial assets by the Fed. This is the primary tool used by the Federal Reserve to control the money supply. Note, the U.S. Treasury bonds held by the Fed are part of the national debt. Controlling the money supply, open market operations. Open market operations, when the Fed buys bonds, the money supply expands as bond sellers acquire money. When the check is deposited at a bank, reserves increase, placing banks in a position to expand the money supply through the extension of additional loans. When the Fed sells bonds, the money supply contracts because bond buyers exchange money for bonds. Bank reserves decline, reducing available funds through the extension of loans. Historically, member banks have borrowed from the Fed primarily to meet temporary shortages of reserves. The discount rate is the interest rate the Fed charges banks for short-term loans needed to meet reserve requirements. Other things constant, an increase in the discount rate will reduce borrowing from the Fed and thereby exert a restricted impact on the money supply. Conversely, a lower discount rate will make it cheaper for banks to borrow from the Fed and exert an expansionary impact on the supply of money. Extension of loans, discount rate and federal funds rate. The discount rate is closely related to the interest rate in the federal funds market, a private loanable funds market where banks with excess reserves extend short-term loans to other banks trying to meet their reserve requirements. The interest rate in this market, in the federal funds market, is called the federal funds rate. Longer-term loans extended by the Fed. Prior to '08, the Fed extended only short-term discount rate loans, and they were extended only to member banks. In '08, the Fed began extending longer-term loans, 5 to 10 years, to non-banking institutions such as insurance companies and brokerage firms. Like the discount rate loans, these new types of loans inject additional reserve into the banking system and thereby exert an expansionary impact on the money supply. During the COVID-19 crisis of 2020, the Fed again expanded these longer-term loans to non-banking institutions. I'm sorry, it's late and I'm tired. Controlling the money supply, interest rate Fed pays on reserves. In '08, the Fed began paying banks interest on the reserve deposits held with the Fed. The Fed generally sets its interest rates slightly lower, 5 to 15 basis points than the discount rate. The payment of interest on reserve provides the Fed with a tool it can use to control both bank reserves and the loan supply. If the Fed wants banks to extend more loans and thereby expand the money supply, it will set the interest rate it pays on reserves very low, possibly even zero. In contrast, if the Fed wants to reduce the money supply, it will increase the interest rate paid to banks on reserves held at the Fed. This will provide banks with an incentive to hold more reserves, which will reduce the money supply. Summary of monetary tools for the Fed. We've got reserve requirements, open market conditions, extension of loans, interest paid on excess bank reserves. Recent Fed policy, the monetary base, and the monetary supply. Recent Fed policy, the money base, and the money supply. Prior to the financial crisis of '08, the Fed controlled the money supply almost exclusively through open market operations, the buying and selling of Treasury securities. Seeking to combat the severe 2008-2009 recession, the Fed sharply increased its asset purchases to substantially increase the reserves available to the banking system, began extending loans to troubled non-bank institutions, and began paying banks interest on their reserve deposits with the Fed. The monetary base is equal to the currency in circulation plus the reserves of commercial banks, vault cash and reserves held at the Fed. It reflects the total of all reserve asset purchases of the Fed for the years. The monetary base is important because it provides the foundation for the money supply. The currency in circulation contributes directly to the money supply, while the bank reserves provide the underpinnings for checking deposits. Monetary base M1 and excess reserves 1990 to 2020. Prior to mid-year '08, the monetary base grew gradually year after year and excess reserves were negligible. Under these conditions, the monetary base and the sum of currency plus required reserves were virtually equal. While M1 has substantially greater than the monetary base, the two expanded together. Since the second half of '08, the Fed has injected a massive amount of reserves into the banking system, causing the monetary base to soar. But M1 increased far less rapidly because of the interest payments to banks on Fed deposits. You see that here. In response to the '08-'09 recession, the Fed vastly increased bank reserves. These expansionary policies were referred to as quantitative easing. While the Fed asset purchases vastly increased the monetary base during 2008, 2014, it used interest payments on bank deposits with the Fed to induce banks to hold more reserves, thereby reducing the expansionary impact on the money supply. Fed asset purchases during the 2020 COVID-19 crisis generated a surge in both the monetary base and the monetary supply. It will be interesting to see if this policy will continue or be reversed. Interest on Fed deposits, bank reserves, and the money supply. The exhibit on the following slide provides data on bank reserves, monetary base, and the monetary supply. Prior to '08, the reserves of banks reflected the reserve requirements. As a share of checkable deposits, they ranged between 7 and 10% during that period. After 2008, interest payments on bank deposits with the Fed were used to control the reserves of banks. During this period, the ratio of bank reserves to checkable deposits was substantially higher, generally 80% and above. Because of the larger reserve holdings relative to checkable deposits, the ratio of the money base to M1 was also higher during this era. The ratio of bank reserves to checking deposits and the monetary base to the M1 supply 1990 to 2020. The ratio of bank reserves to checkable deposits, the blue line, as shown here. After 2008, both of these ratios rose as the Fed used its interest payments on deposits with the Fed to provide banks with an incentive to hold reserve balances. The Fed and the Treasury. The U.S. Treasury is concerned with the finance of federal expenditures. It issues bonds to the general public to finance the budget deficits of the federal government. It does not determine monetary policy or monetary supply. The Federal Reserve is concerned with monetary climate of the economy, uses the purchase and sale of treasury bonds in its conduct of monetary policy. And it's also responsible for control of the money supply and the conduct of monetary policy. Ambiguities in the meaning and measurement of the money supply. The changing nature of money. In the past, economists have often used the growth rate of the money supply to gauge the direction of monetary policy. Rapid growth was indicative of expansionary monetary policy, while slow growth or a contraction in the money supply was indicative of restrictive policy. Recent financial innovations and structural changes have changed the nature of money and reduced the reliability of money growth, figures as an indicator of monetary policy. The changing nature of money in recent decades. Widespread use of the dollar abroad. At least one half to two-thirds of U.S. currency is held abroad. These dollars are included in the M1 supply, even though they are not circulating in the U.S. Substitution of electric payments for checks and cash. Increased use of debit cards and various forms of electronic money have reduced the demand for currency. These innovations have reduced the reliability of money supply figures as an indicator of monetary policy. As a result, most economists now rely on a combination of factors, such as interest rates and growth of nominal GDP, to evaluate the appropriateness of money supply. Entrepreneurs who have changed our lives. Peter Thiel, Most of you have probably used PayPal and therefore benefit from the entrepreneurial genius of Peter Thiel. Thiel was a co-founder of PayPal in '98 and served as its CEO. He sold the online payment company to eBay in 2002 for $1.5 million, personally netting $60 million. This is also a major investor in Facebook and still serves on its board of directors. Thiel has many and varied talents and interests, from human rights, philosophy, and technology to film. His creativity carries over to his charitable giving. In '08, he pledged $500,000 to the New Seasteading Institute to support its mission, which is to establish permanent autonomous ocean communities to enable experimentation and innovation with diverse social, political, and legal systems. In '10, he established a Thiel Fellowship, which awards $100,000 each year to 20 young people who promise to quit college and create their own entrepreneurial ventures. Questions for thought. How will the following actions affect the money supply? A reduction in the discount, an increase in interest rates the Fed pays banks on their deposits with the Fed, the purchase by the Fed of $100 million of U.S. securities from the commercial bank, the sale by the Fed of $200 million of U.S. securities to a private investor. Are the following statements true or false? When the Fed sells bonds, this action will provide banks with additional reserves and therefore place downward pressure on short-term interest rates. Yes. Well, if the Fed wanted to expand the money supply, it could do so by increasing its purchases of Treasury bonds. The Fed's ability to purchase U.S. securities and thereby expand the money supply is A, limited by the gold requirement. The Fed cannot write a check unless it has a sufficient amount of gold to back the newly created money. B, limited by reserve requirements. The Fed must maintain 20% of its assets in the form of cash against the deposit that it is holding with commercial banks. And C, unlimited. The Fed can create money simply by writing a check on itself. During the years following '08, what happened to the ratio of bank reserves to checking deposits? Why? What happened to the ratio of the monetary base to the M1 money supply? Why? How did the Fed respond to the 2020 COVID recession? What happened to the monetary base and the M1 money supply during the following money supply during and following this recession? That's end of chapter 13. I thank you